As we head into the Fed meeting, potentially, likely the first rate cut in 10 years, everyone's talking about the benefits, but what about the downside? The likes of Guggenheim's Scott Minerd has recently warned about inflating asset prices. So if you're going to be concerned, here's a couple areas to potentially keep an eye on. For one, that's the riskiest area of risky corporate debt, being leveraged loans and private credit. So the private credit markets have now grown to $866 billion. If it keeps moving at this pace, we could likely hit that $1 trillion mark. Also, according to Covenant Review, that's a research firm, debt to EBITDA for companies that borrow using leveraged loans have seen it expand to 7.5 times. Also, we have heard it discussed many times. The amount of money wrapped up in negative yielding bonds has passed $13 trillion, but now it's moved quite quickly towards $14 trillion as well. That's not just sovereign debt. We even have some high yield bonds within there as well. And if you take a look at the equity market, sure, from a top-down level, the S&P is trading at 17 times forward earnings, a bit expensive, but nowhere near bubble heights. However, some have warned that there could be pockets. For example, Rob Arnott over at Research Affiliates told Bloomberg Television recently that maybe the FANG stocks could be forming a bubble. This white line is an equal weight version of the FANG stocks. This blue line that looks pretty flat is the S&P 500. Since 2013, the FANGs have moved 1,000%. That's about 10 times that of the S&P.